Hello and welcome back to the Jerusalem Post. I'm your host, Tamar Uriel-Beeri, and I'm joined today by Adiel Weiss, a fixed income analyst with Bank Hapoalim. Adiel, welcome.
Hi.
So, Adiel, this past year has seen a drop in the bond markets, yet we're hearing professionals such as yourself saying to look at the glass half full. Can you clarify on what that means in this situation?
Yeah, I try to make it simple. When a bond price goes down, it yields go up. And when the yield is higher, it's much more interesting to invest in. So that's the half full glass.
Let's break that down for a second for the newcomer to bonds. What is a bond? How does that work?
Well, a bond is very much like a loan from the bank. When you take a loan from the bank, you know when you need to pay the money back. You know the interest that you're paying. And so the bond is very much like it. The only thing is that you are the one who gives the loan to the government or to corporate, okay? So when you give the loan, you know when the money is coming back to you, you know what interest you're gonna get. And another thing, that bond is marketable. You can sell it, you can buy it whenever you want to.
Mm-hmm.
So the price you buy the bond in the market, that's actually set you up for the yield that you're gonna get. So when you buy the bond, you know exactly what yield you're gonna get, the average yield to maturity.
So it's kind of like a safe zone in terms of investing?
It's much more safer than stocks because you can guarantee a known return until maturity, okay? But there's still volatility because it's, as I said, it's marketable. So during the period of time, there is a volatile movement. But if you look from the beginning to the end of the term, so it's almost riskless.
So you said before, yields rise when the market falls. It seems though counterintuitive. So now that we kind of understand the basics of bonds, can you explain how that works?
Okay, basically in bonds, you know most of the things. You know the redemption date. You know how much money you're gonna get back. You know the interest you're gonna get during the lifetime of the bond, okay? And the only thing that can affect the yield you're gonna get is the price you're buying it in the market, okay? As higher the price will be, then the lower the yield will be, okay? And the opposite way, the lower the price will be, the higher the yield will be. That's how price affect the yields, and that's the reason they're opposite, okay? Another thing that can affect the yield, or when we're trying to calculate what yield you're gonna get, is we called it modified duration. That's the average time of for the investment to see the whole amount of money back. I mean, including the principal and all the interest that is gonna get during the lifetime of the bond. Okay, and the modified duration, that's the equivalent of the how the time can affect the volatility in that specific bond.
Got it.
Which means as longer the modified duration will be, then the bond will be more volatile. And as an investor, I will demand a higher yield for that. So usually we'll see that longer bonds will return higher yield.
Got it. Okay, yeah, that makes sense. Now, a lot of our listeners surely have investment portfolios. How are bonds specifically tied into their investments?
Okay, so bonds are the, let's say, government bonds, okay? They are the riskless way of investing. So the basic of every investment that we're looking at, we need to know on what interest, what is the alternative, okay? So as I said, government bonds are considered riskless. So I measure everything according to what government bonds yield gives me. For example, okay, if I can get, let's say, 5% in government bond, okay, so I won't take the risk and invest in stocks that can give me 6% because the difference is not enough for me, okay? So the bonds are the basic of the solid basic of any portfolio, okay? And now also in bonds, we have several levels of risk. Government bonds are riskless, but corporate bonds have a little more risk because the company not necessarily will be exist in another 5 or 6 or 7, 10 years, okay? So
Right.
that risk I'm taking. But both of them are less riskier than stocks. Now, as I said, because government bonds are riskless, so the market looks at them as the benchmark of what the fund rate should be for each maturity date, okay? So that actually gives us a curve along the years, okay? Which every year I can tell what the yield I'm gonna get when I'm investing in government bonds. And that curve actually affects any other investing.
Just as an example, if we kind of zoom out a second, what does a solid investment portfolio look like in terms of bond composition?
Okay, so it's like as any other investing, the name of the game is diversification, okay? We won't invest only in one kind of bonds. So the solid basic, as I said, will be government bond, both nominal and inflation-linked bonds. So the investor will be able to have some defense from rising inflation, okay? Above it, there will be a layer of investment grade corporate bonds, which means high-rated companies. Also, we'll have diversification of different sectors in it. Technology, healthcare. So basically, we'll have exposure to all kinds of bonds. And if an investor has a foreign account, so here in Israel, you can also invest in bonds abroad, in dollars or in euro.
So the wider the range, the better.
As always. That's the basic rule in investing.
Got it. So a lot of what we've heard lately, though, surrounding the economic state in Israel and in many other places as well, is relating to inflation. How is this tied to bonds? How are bonds affected by inflation? Or say, how does it affect foreign trade?
Well, bonds are the market way of signaling signaling the central bank of how high the rate in that specific state should be. So when the inflation rise higher, so the rate should be also higher, okay? And what's going on, what's happened, that the short-term rate rised up. In order to say the Fed, for example, you need to rise the funds rates up in order to fight the inflation, bring it lower, okay? So people will be able to live and pay for their accounts and buy things. And actually, the short-term bond give higher yield than the long-term bonds. And that makes what we call an inverted curve, okay? I said before that usually we want to get higher yield in long-term than short-term. But when the curve is inverted, it's the opposite way, okay? The short-term will give higher yield than the long-term. And most of the time it happened in the past, it was a pre-signal for a recession that is gonna come. So actually that's the way the market looks ahead of the economy. And of course that affects everything, because when you're afraid of a recession to come, then you act differently, than you're getting prepared for the worst.
So my last question for you is, what would you say a well-prepared customer should do at the level of distribution within the debt market?
Well, as I said before, the name of the game first is have a very big diversification of both nominal and inflation-linked bonds. Have a wide range of exposure for different sectors. But I think the most important thing is that know the best you can assess the range you're gonna invest in and the level of risk that you're willing to take. Okay, because if you don't want to take risk, it's one kind of portfolio. But if you want or willing to take a high risk, it's another different of portfolio. So I think the first thing an investor should ask himself is how much risk I'm willing to take and for how long.
Amazing. Adiel, thank you so much for joining us today.
Thank you very much.